Okay, good afternoon, everyone. This is Keith Stracula from the Structured Products Association. I want to welcome you, all our participants, for this, our second webinar, second in 2 weeks, following up on the Structured Products Legal Regulatory Compliance Series for 2022. This is our 19th annual webinar or conference. We have live usually when we're not in COVID mode. But glad to have everybody aboard here on virtually speaking. So today we're going to go through an industry outlook, and a review on how this record-setting year came to pass, some of the highlights on that. Then we'll swing into some of the challenges and opportunities we see going forward for 2022. And our last panel will tackle some of the underlyings that we're seeing, some of the new and novel things, as well as some of the tried and true that's happened before. So before we get started, a couple of housekeeping items. I want to thank Anna Pinedo and the team over at Mayor Brown for making this possible. We always appreciate the opportunity to team up with them to bring high-value content to our members and to the clients of the firm. And so this, again, is the second of two webinars, and appreciate everybody's time. So here's today's participants that you'll be hearing from. Todd Dilatush of Luma Financial Technologies, Kjeld Enberg of Oppenheimer, Joe Inzerillo of BNP Paribas, Joanna Kanakis of Halo Investing, Stanislav Varin of Credit Agricole, and Dimitri Zistris from CIBC. What's been really exciting this year is to see the phenomenal growth. Just if you're looking at how structured notes have progressed in terms of notional size over the last couple of years, it's been very dramatic. So in 2019, we came in at about $53 billion in notional amount of transaction. Now, a quick couple of notes on this. This is going to be SEC registered product only, so it doesn't include the 3A2 structures. So these figures are probably another 30 to 35% higher than the numbers that we're reporting here. And also, of course, our friends at Prospect News, Emma Trinkle, we want to give a shout out to her because she was responsible for getting us these statistics over the next couple of slides. So in 2019, $53 billion for the year. The next year, it leaped up 36% to $72 billion. And just this past year, you can see we're at 94 plus billion. Again, this is SEC registered product, not inclusive of any institutional 144A structures or structured investments in the way of insurance and or trust securities. Okay, Melissa, next slide. When we look at how the pie was split up this year, no surprise, it was a huge year from an equities perspective. So if you look at the pie chart, obviously to the left, the blue slice represents the index-linked products, and index-linked structures represented 53.9 billion of that overall amount, over 57%. But we weren't done with equities yet, because on the single stock side, these are mostly autocallables. That's almost another 20 billion, another 21% of the market. Also, you can see basket structures, 6.6 billion. A lot of those baskets were also equity and ETF. What we didn't see a lot of this past year were commodities, rates, or FX. In fact, there was only one FX deal that was reported to the SEC last year. So it was a market that was driven by record levels in most of the equity indices, and that was reflected in our 94.5 billion notional. Many commentators have been noting that as structured products becomes more mainstream and becomes more of a substitute for vanilla indexing or Delta One structures, as these get discovered, it really takes it to the next level. Autocallables, which we'll talk about in a little bit more depth with the Kjeld of Oppenheimer, also drove the market, because as those got called, then investors had a successful experience with them and then would re-up with the follow-up series. It's a phenomenon that we've seen a lot in the unit investment trust world, and now we're starting to see that in structured notes quite pervasively. Okay, next slide. Now, also you can see here that when we start looking at the number of deals, there could be as many as 30,000 plus, if you're including the 3A2 plus 3A2 world. But on the SEC registered side, 25,336 deals were registered with the SEC last year. That's just a phenomenal number. Obviously, the lion's share of that was in the index-linked world at 11,116. But also the single stocks, there were a lot of deals that would be smaller size, but in terms of volume of deals, single stock represented 34% of the market. So in combination between just those two from the deal size, you're looking at roughly 77, 78% of the structured products market from last year. Again, FX just had one deal, commodities 46, rates were 136 deals. And an interesting phenomenon, we'll talk a little bit about the controlled vol structures, which have just started to pop up. There were 255 of those deals last year, and more are in the works so far in the new year. Next slide. Okay, so what we have here is a list of structured notes issuances issues that come by USD. These are the league tables. Barclays Bank came out on top this year, and overall structured notes issued at 12 billion. Morgan Stanley and close behind, almost 12 billion itself at 11 billion 970 million. And Goldman, again, right behind Morgan Stanley at 11.7 billion. Citi, 11.0 billion. And rounding out the top five, JP Morgan Chase with 10 billion. Just a lot of great numbers that were put up this year, and also quite a bit in terms of notional amounts for some of the others in the league tables on a double-digit percentage basis. Okay, next slide. Okay, now this represents structured notes issuances by the number of deals, and what that entails is UBS by far and away is the market leader in terms of the number of notes that it issues, and a lot of that is driven by the technology that the firm has to be able to on a big scale in terms of much smaller deals. They use technology to be able to come out with over 6,000 deals this year. In fact, closer to 7,000. JP Morgan is next at about half the number with 3,421. And then just as you'd expect, Citi, Goldman, and Morgan Stanley round out the top five. They're all in the upper 2,000s. But again, the numbers that are put up by UBS and JP Morgan are quite phenomenal. And Barclays, of course, cracked the 2,000 number deal as well. When you start to look down at some of the Canadian banks, for example, you see that they have fewer numbers of deals, but because of their position as issuers of structured notes, rather than using the proprietary distribution, they go to the larger investment banking channels such as Bank of America and UBS, and so their deal sizes are just much more on a notional basis, on average, much higher than, say, for example, UBS. Okay, next slide. Okay, the last slide I want to tackle here as we step through the year in review. This is structured notes distribution. So this is kind of the other leg of the structured notes business, where we were talking about the issuers. Now these are the distributors, and Bank of America had another phenomenal year, over 12 billion distribution with just 989 deals. So when you do the math there, the average size of the Bank of America deals, going through the Merrill Lynch channel, is just phenomenal. Morgan Stanley, also its high net worth division and wealth management group just came in under 12 billion. Phenomenal numbers that are being put up by Larry and the team over at Morgan Stanley. Goldman, 2,700 deals at 11.7 billion. Citi and Barclays rounds out, and we'll throw in JP Morgan also, Those are the top 6 that are all in the $10 billion and up club. UBS had a good year, $9 billion, and then drops off from there. So once again, the distribution channels that are tried and true have come through this year with phenomenal numbers. I think that the Bank of America scenario was alone was up 47% from the previous year in terms of the notional. So we'll stop there and go on now to the industry outlook panel. I want to bring in Keld from Oppenheimer. Keld, if you wouldn't mind just talking a little bit, just give a quick overview of what you do for Oppenheimer, your role, and a little bit about yourself.
I run the structured products business here at Oppenheimer. It's a relatively new business in that I started over here about 4 years ago. But I have basically built out it's a distribution desk, right? So we have about 1,000 FAs here, and we trade and distribute structured products. I use my experience that I have from previous employers. I was at UBS for many years, and then at Credit Suisse, and also at Deutsche Bank. And we try to, emulate what is available at those places. So we're still a small shop, but I think if those of you who are in the industry were to come over here and look at how we do things, you would recognize almost everything about the business and how it's run.
Well, terrific. You've really brought Oppenheimer along over the last couple of years. Let's talk a little bit about the year in review. So you kind of had a frontline view of what was working last year, and it seems like it was the year of autocallables. You want to talk about what you saw at Oppenheimer and generally speaking, what you saw in the industry from a distribution perspective?
Yeah, I mean, I think the autocallables is definitely, but when you have a big headline number like 90 billion, the autocallables is a huge part of that. And I think often the temptation for us is to discuss sort of new, shiny, and more esoteric things that's going on in the industry. But the autocallables have just become such a huge part of the business that I think it merits that we spend a little bit of time on it. It's an interesting story also just from the point of view that, I mean, I think about 12 years ago, there was hardly any autocallables around. It's in that sense, it kind of, it came up as a structure in the aftermath of the big financial crisis. Back then, people were still doing a lot of more traditional reverse convertibles. And of course, for a long time after 2008, you still had volatility that was so high that you could get very generous yields on reverse convertibles, and you could do them with very short maturities with lots of protection. But starting in 2010, we really saw a slow shift towards autocallables. And I think sometimes the assumption is that autocallables have become so popular because of that. Like, it does allow you to have several business opportunities in a shorter period of time because at least in the rising markets, the notes will get called away and investors will tend to reinvest. But I think that's really only scratching the surface, and it's not really the reason why the structure is so popular. And I speak to a lot of clients, both retail clients, but also large institutional clients who have invested in this type of note. And I think, and this is maybe for people who don't spend all day, front office. What's worth bearing in mind is that the autocallable, first of all, it provides great diversification in an equity portfolio, right? So we've seen it this year with, the broad-based indices coming down sharply, individual stocks pulling back for the most part. And investors really enjoy having something in their portfolio that continues to generate a positive return, even when the market is down, 5, 10, 15%. And the autocallable is perfect for that. I mean, you could have bought something at the height of the market in December, and all of those notes are still looking good, and they will be paying coupons, and it doesn't look like there's a lot of things that are not going to get called immediately, and that's fine. That is real diversification, because you have investments that don't rely on the market always churning higher in order for you to generate a positive return. But another thing that the autocallables provide to clients is that they allow clients to take different types of risk. And what I mean by that is, with a lot of structured products and traditional investments, you expect a certain given return for the amount of market risk that you take. But with the autocallables, you effectively take some market risk, but then you also put your cash flows at risk, right? So coupons are at risk, both because you have a barrier on the downside, but also because you have call risk in the notes, and you're not guaranteed a stream of cash flows until a note matures. Some people think that that is one of the drawbacks of the note, but what it does is that you get these very high returns for, relatively speaking, what is a quite small amount of market risk. Or to put it a different way, if you didn't want to have a call feature, or if you didn't want to have your coupons at risk, you would have to take a lot more market risk in order to get the same level of return. And once people sort of see that trade-off, a lot are convinced that it makes sense to take sort of the non-market risk rather than taking more market risk. And you could spend some time looking into behavioral economics of why that is, but I think in layman's term, it just looks good that you can get a 10-12% return, and you can sort of repeat that through different markets and over a longer period of time, without taking the same amount of market risk as you would otherwise have to take in order to generate that return. By the way, if you can make 12% over a longer period of time, even if you have to reinvest your money several times, you double your money in about 6 years, assuming that you reinvest the proceeds, right? So it really all adds up. And the last thing I will say about autocallables, and I'll keep it short, is, I mean, it's not unknown, but the single stock story is pretty important. So people like to invest in single stocks. They like to think about what's going on in the market and to take advantage of a stock selling off or a stock going sideways, and try to monetize some of that the implied volatility in the stock. And I think for that reason, the autocallable really has an advantage over other structures that don't lend themselves as easily to being single stock plays, because it is still something that people like to think about individual stocks and invest in individual stocks, both directly and indirectly via structured notes. And all the great structured notes we have that are repeatedly linked to the S&P and the Russell, they just don't necessarily generate the same amount of interesting conversations. So I think those are some of the reasons why the autocallable structure is so popular. So again, diversification, great returns, ability to take non-market risk, and then the single stock story. And I think that the fact that that it's also such a big driver of the business for the industry is really just kind of a very small part of that story.
Appreciate that. It seems to me that this has been a breakthrough year in the sense that investors are looking at different ways of gaining exposure to the white hot equities market, and they've discovered autocallables, and that's I think a real tribute to some of the educational efforts on the part of the industry, and especially on the distribution side. I'd like to flip over now to talk to Dimitri and Joe, in particular Dimitri. So this is going to be a transition year for LIBOR. And I think you've been in the middle of some of those conversations. So tell the audience a little bit about what you do at CIBC, your role there, and then tell me what your thoughts are on the industry's transition out of LIBOR as a benchmark or an underlying.
Sure, Keith, and thank you very much. I'm happy to be here. I'm in internal legal at CIBC, Capital Markets Division. And first, I want to say that any comments today that I give are not CIBC's, but they're my personal comments. So we've been seeing a lot of LIBOR transition issues in the course of the fourth quarter and into this year. Issues like if you take an assignment or you participate in a new loan in 2022, how does that work? If it's a LIBOR-based loan, what happens there? The other place we've seen this issue, and we'll talk a little bit more about these products later, is any kind of index you have that might have a LIBOR component where you're carrying some cash component in the index as you move from one asset to the other to another asset, or you vol control. The issue becomes, is that a product that the Fed had rules about? Could you still market that particular index into 2022? How do you look at that? And regardless, let's say you could market that index into 2022, even though it had a LIBOR component in it. How are the relative entities who are involved in that product, how are they going to deal with LIBOR going forward? So this involves the S&P, it involves the index administrators, it involves the banks who have these products on their books, who have to look from a risk and perspective. If we change the underlying fixed rate in these products, what does that do for hedging, for profits, for booking, and the like? So there's a lot of discussion going on now within the industry, also with the insurance companies who have a lot of these indexes built into some of their FIA, their fixed index annuity products. So you've got a wide-ranging discussion going on. It revolves around SOFR, for example, and some possible other indices that might come into play here. So other rates may come into play here as these products have to get revised to start dealing with the fact that LIBOR will, at a certain point, just not exist. So.
And so I imagine you're part of some of the committees on how you're going to unwind some of those transactions, or involved in some of those discussions on how you leg out of existing products.
Yeah, so I think people are hoping that you don't have to unwind those actual indices, that your documents give you enough authority to change that underlying component of your index product. Obviously, everybody wants these products to continue to be built into notes and into FIA contracts, for example. But there is an industry initiative starting, and I think this whole process, from what I'm hearing and what I'm talking to people internally, is going to take 6 to 9 months. I think there'll be, S&P has some of these indices, and they're already talking about changing their underlying component from LIBOR to SOFR. And there are other indices that are kind of trying to get into the mix to have their particular index used in the underlying components here.
Fantastic. Thanks for that, Dimitri. I'd like to flip over to Joe Inzerillo now, Joe from BNP. Joe, good to see you again. We'd like to talk with you about the CMIC, the Chinese military industry, industrial companies, and some of the issues that you've seen. So this is an issue that is coming up that is relatively recent, and your firm has been taking a look at it. If you don't mind, for our audience, just tell them a little bit about what you do at BNP, and then we'll get right into
Sure.
presentation. Thank you.
Yeah, sure. Thanks, Keith. Appreciate the invite and being here. I think I hate to say, but I think we've been doing this for well over a decade now. A lot longer than that. But yeah, so as you said, like I'm at BNP. I head up a couple of the legal groups at BNP. Structured securities, structured products is one of them. Recently, I also took over the debt capital markets and equity capital markets. Those teams as well. I've been doing this for about 20 years in structured products and I think at our shop, and I think a lot of people here, this is sort of the DNA at this point of a lot of the folks that are participating and the folks that are on the phone being here. So I appreciate it. The current administration issued this executive order, and it really replaced the previous administration's executive order that put a ban on U.S. persons trading in securities of companies that were determined to be these Chinese military industrial complex companies, CMICs, as we call them. And this executive order, Biden's executive order was last June. There's this right now, we're in this period, which is called the divestment period. And the divestment period started last August and is going to go through June 3rd of this year, June 3rd, 2022. And essentially during this divestment period, if you are holding a security that's linked to one of these CMICs, or it's a derivative or designated to provide investment exposure to a CMIC, these would be covered products, and you would be prohibited from purchasing a security that are issued by a CMIC anywhere in the world in any currency. So as we think about structured products, let me finish up the divestment period. So this divestment period, which we're in now, would permit anyone to engage in transactions to dispose of securities that might be captured. So what happens after the divestment period, the post-divestment period, after June 3rd of this year? Essentially, any U.S. person is prohibited from trading debt equity securities that are issued by these companies, these CMIC companies, but it also includes derivatives, and it includes products that are designed to provide, as I said before, provide investment exposure to these CMICs. And I'll bring it to structured products in a second. OFAC, which is part of Treasury, issued some FAQs. I would expect they may issue another FAQ potentially. The CMIC list is published on OFAC's website. But when we talk about structured products and, why do we care about this? Why are we here? Really, with structured products, we're talking about U.S. persons and we're talking about securities. So the structured products that we know, such as notes, clearly are securities. So if you have a note, which the product would be covered. There's some talk with MLCDs, not necessarily covered. Most people would view MLCDs as being a bank product and not necessarily a security. But that gets a little more complicated when you think about how most banks hedge, let's say an MLCD linked to an equity index, such as HSI, the Hang Seng Index, which does have a CMIC component. While the MLCD may not be a security, the option that's linked to the equity index is a security, so it may get captured in there. So if you're talking about structured products, structured notes, which are securities, covering underliers, individual equity and debt securities of CMICs, but again also covers derivatives and instruments that are designated to provide investment exposure to these underliers. So when I think about underliers, that I think in our world, in structured product world, we don't typically link to individual equity securities that are one of the CMICs, but clearly Hang Seng has a component that's a CMIC. So let's figure out what's going to happen there. I think people are taking an inventory of their notes and their options and other securities that might have HSI underlier. EEM, which obviously is a very popular ETF, may shortly have a CMIC component to it. So when you look at the overlap of securities and these underliers, I think you have a lot of issuers that are going to be in a position where they're taking inventory these products and derivatives that are linked to CMIC or or an equity index that has a CMIC in it. So when I think about next steps, for folks, I mean, certainly taking an inventory of what you have, which is not always not that easy. The CMIC list can change. So right now, you may not have an issue, but if there's an underlie or a CMIC that's added to OFAC's list, you sort of have to take a look at that. Want to stress that there's no requirement to divest in it. So if you have a note that's linked to a product that is covered, is captured, you don't have to sell it. You should be able to receive coupon payments if your maturity is after the divestment period. So again, after the June the June 3rd date, that shouldn't be a problem. That should not be covered. But if you are holding a covered product after June 3rd and you want to unwind it, it gets kind of complicated, and that's where I think you might see some guidance from OFAC. You might see some guidance from other folks about that, because someone needs a license to do that, and who has to get the license? Where that comes from, that's sort of a TBD. But also, I think some of you in the market have saw SIFMA sent out a survey, which is due tomorrow, by the way. So I would encourage everyone to reach out to your internal colleagues and participate in that survey. But SIFMA sent a survey to members about this issue. So, and they asked some questions about some of these issues that we're raising. But I think the market is some questions about this, right? The people certainly have some questions, and what's going to happen after June 3rd, TBD. If you are holding one of these instruments and you want to unwind it, it's not that simple. You can hold it and let it go to maturity. But we all know in structured products, people really do appreciate and do look to unwind securities every so often, adjust portfolios, and the like. So that's TBD. So really, my final thought was just really to encourage everyone to really reach out internally to make sure you do see the SIFMA survey and you participate. And again, that's due tomorrow, the SIFMA survey. So thanks.
Fantastic. Thank you, Joe. Appreciate the thorough analysis of this issue. I should also mention to the audience that we do have a Q&A box. So if there are questions that you may have from the panelists, if you put those into the chat box, we'll make sure that those are covered. And we have about 15 minutes left in this presentation. I want to go back over to Dimitri to talk a little bit about on the insurance side, fixed index annuities and some of the insurance products. And so CIBC is very prominent, I believe, in the fixed index annuity world, Dimitri. So why don't you give us an overview of what's going on over there, what you're seeing in the market, and some of the challenges and opportunities that come across your desk?
Sure. And since Joe's talking about his street creds, I should point out, Keith, that when this organization started, you and I were amongst the beginners with this, with a fellow from Credit Suisse. So I go back to the early days as well. So
it's funny. I was just talking. Gautam's name just came up yesterday in another business conference. So it's a clearly small world, and it's amazing that we're decades later. Here we are. Go ahead, Dimitri. What's happening in your world in the insurance product side?
Right. So we started this business a couple of years ago, and a lot of competitors probably on this call and whatnot. But what we're seeing at the end of last year, beginning of this year, we're seeing the demand is still very high for custom indices being linked into fixed index annuities. Most insurance companies are going to add one or two indices a year in their product, in their products, either by doing a new particular FIA product or adding it to an existing product. But what we're seeing now, coming to 2022, is that a lot of smaller insurance companies are looking at this at FIAs, and the market's going to expand accordingly. If you added S&P in these indices and didn't have a vol control aspect to it, Obviously, with volatility increasing, you're going to have a very expensive option that you, the insurance company, is going to have to hedge with. So a lot of these indices, because of that, because the insurance company is hedging these particular equity, let's call them equity-linked indices, they need to keep that cost steady. They need to keep that cost within certain bounds, so at least they have some profitable products that they're putting out there. What we see is that everybody obviously is trying to differentiate themselves here. So you had the development of a lot of custom indices that go different than the S&P indices, that try to pick out a particular sector, outperformers being selected over performers that are, not doing well, and coming up with some kind of modeling around that. One thing that has happened is any indices that were linked to bonds or rates have gotten really, got hammered in the fourth quarter, and with volatility increasing and rates going up, those indices have been, not been performing very well. We're also seeing a lot of AI or artificial intelligence being built into these indices, into the methodologies, to how do you select, a certain component of stocks. Let's say you're looking for stocks that pay high yields or high dividends or other components like that. And then what is being built around that, and what happened in, I'd say, 2020 and 2021, was a lot of caps and floors and resets in those vol control indices. But what happened in that space is it got so complicated that even the financial advisors who are going out to the clients who want to purchase some annuities, they start to come back and say, we can't even understand this kind of index and how it works. And when you get into that space where the financial advisor can't understand it, it becomes there are some issues with that, obviously, from a marketing perspective that I think we're all aware of. So these new insurance companies, the smaller ones, as opposed to the ones that we've seen over the years that have been very active in this space, they've come back, and there are a lot of conversations going on with them. And they've said, show us some stuff in this market, but we want it to be simple. So there's a trend going now to a little more simplicity with these new clients coming into the space who are looking for something that's not as complex that some others have adopted in 2020. So that's basically what we've been seeing in this space last year and beginning of this year.
Appreciate that. And so when we start talking about the more simple indices, is that moving away from the quantitative strategy, something that's more of a static kind of predictable, either S&P or thematic type of index?
I think it's moving away from indices that that have caps and floors built into them. So if you go down 12%, you have only a 10% loss or something, or if you've gone down 5%, there are all kinds of caps and floors that banks have been putting into these indexes, built into the FIA product, that have made them really sophisticated and not really to be marketed to individuals who are the ultimate market in the FIA marketplace. So they may be the same kind of concepts. Sorry.
And I didn't mean to interrupt, but so it's really about payoff profiles as opposed to the underlying.
Correct.
Is there a demand from what you're seeing? I know you do some proprietary indices at CIBC. They're moving away from the S&P, Dow Jones type products and MSCI, and more towards the prop indices? Where do you see the bifurcation of the market in terms of?
Yes, because people want some kind of way to differentiate themselves in the market. So the indexes are becoming more specific to certain sectors, to certain particular plays, as opposed to a broad-based index, right? Everybody can produce that broad-based index and build in a vol control element to it. But where you want to further the conversation with the insurance companies is in terms of particular sectors of the industry, the market, some kind of strategy play going forward that might address an inflation geared economy, for example, for the next couple of years. So, these are ways to differentiate yourself and bring value to particular products the insurance companies see some value in with their client base.
That's terrific. Thank you for that, Dimitri.
Sure.
Joe, is BNP involved in the fixed index annuity business, or where's their traction on insurance linked product or insurance product?
Yeah, look, I think from our perspective, we've been in that business for actually for quite some time. With some of the strategies from, I guess, from years ago. So I think a lot of the banks have built that business. You had some first movers, probably more than 5 years, maybe 7 years, 8 years ago, maybe longer. And I think at this point you have a lot of banks that have gotten into that space, and really just from some of Dimitri's comments, even about the QIS strategies, obviously in Europe, these the QIS indices have been very popular for many years. But you do see some newer, interesting indices coming in the U.S. The indices, these days with the decrement, and you see the disclosure. And I will say that in looking at some of these, vol's a little bit higher. There's some leverage, but the disclosure is pretty good. I mean, I look at these and there you see the disclosure about the indices being reduced by a certain percentage every year. But I think people have done a pretty good job, with disclosing it and really putting some of the features that are beneficial, let's say, to pricing, not as beneficial to having anything reduce the value of the index. Obviously is going to hamper performance, but I think you do see a lot of people doing a pretty good job with really focusing on disclosure and making sure people really understand what they're buying.
Fantastic. Kel, on your side, is Oppenheimer involved in the distribution of annuities products, and in particular fixed index annuities?
Yes, but it is not something that I am involved in. So my only sort of path into this market is via the market linked notes, principal protected notes, or market linked CDs. Obviously, that's a relevant discussion as well. But not for annuities. I don't know much about that.
Appreciate that.
Yeah.
Okay, so as the panel winds down, I want to kind of go around the horn, and I'd like to include Anna on this as well. What's top of mind for you guys? What are you looking at in 2022 as what's going to take up your bandwidth? What are the most interesting things that you're working on, or the most challenging things you're working on? And I'll start with Joe.
Sure, thanks, Keith. I don't know. I have a few definitely a few reactions to that. One is, last year you saw an increase in the RIA growth, with folks coming into structured products. So that's likely, certainly going to continue. Where you have RIAs coming in, in a much bigger fashion, looking for structured products to solve some of their client needs and client demands. So definitely that, I think you'll see that continued with increased volatility. The auto calls won't necessarily be called, of course. You won't have that role. So let's see some of the challenges and anticipate some of the challenges in the market with so far increased vol. But I also think, and I know you have in a panel later, but technology, I think focusing on technology and everyone being a lot more focused on that with, higher volumes, smaller ticket sizes, being focused on cost, tighter margins, needing to be quicker to market. I think you're going to find a lot more people improving their technology, but also finding solutions, on the legal side for, with technology in order to meet the demands of clients, but also, being very relevant in terms of speed and cost. So I think you're going to find a continued focus in that area as well.
Great, Joe. Thank you. Dimitri, how about yourself? What are you seeing for?
One thing, maybe not so structured products related, but obviously I think we're all involved in securities-based swap dealer stuff that's going on. There's a lot of SEC rules that are coming out that people are focusing on reporting and private equity fund disclosure. But also, crypto and cannabis. I think a lot of us are involved in some of those questions as to, reputational risk, where those products are going. There are some interesting developments in crypto, which I think we're going to talk about a little bit later. But think of those as underlyings, or in the case of building baskets around each of those products that present some interesting internal issues for, I think, financial institutions.
Fantastic. Kel, do you want to take a whack at it? What, aside from autocallables, what's happening in your world for coming year?
No, I think Joe hit the nail on the head, to be honest. I mean, it's going to be an interesting year. I still think there's going to be a lot of flow into autocallables of new money, because we are, maybe for the first time since we bottomed out in 2009, we are looking at a year where, this bull market may be grinding to a halt, and we may actually have kind of a soft equity market. So I think a lot of people are going to find autocallables as a way to, to invest in that type of market. But obviously, with the 10-year coming above 2% today, I know that a lot of people sitting out there saying, this, now we're going to start doing some principal protective stuff. If, to the extent that we still use that terminology, CDs are going to come back, and not just linked to these vol-controlled indices that, that isn't for everyone, partly because they've become more complicated and more difficult to explain. You are going to start seeing CDs with reasonable maturities that can be linked to sort of benchmark indices. Obviously, a European index like the Eurostoxx 50 is going to come into play very quickly, because the forwards are cheap with high dividends, but eventually you'll see notes and CDs linked to the S&P 500 as well. If we get 7 rate hikes this year, as some people predict, then there will be a lot of business done in that space.
Makes sense. And I want to flip it over to you as we wind down the panel. What are you seeing in 2022 as big themes from where you're sitting?
So from the lawyer's perspective, we certainly have a very different Securities and Exchange Commission and a very different tone at the SEC. We didn't have an opportunity during our last panel to talk about SEC enforcement and SEC examination issues. So I want to touch on some of the things that we're thinking about or worrying about on that front. So we do expect from the SEC's Division of Examinations, which is what OC, Office of Compliance, Inspections and Examinations, is now renamed. We do expect some focused attention on how broker-dealers are discharging regulation best interest. And we've already seen a fair bit of commentary about this. There have already been a number of speeches, a number of papers and findings about Reg BI. I would not be at all surprised if we see something about how broker-dealers are dealing with Reg BI in the complex products universe, not necessarily specific to structured products or necessarily calling out any firm for sale of structured products, but generally complex products. We all know this is an area where there are certainly conflicts of interest, and there are other interesting issues to consider. So Reg BI and Reg BI related issues, certainly something to think about. I would echo Dimitri's comments on security-based swaps. Chair Gensler obviously is most familiar with and most comfortable with anything having to do with the regulation of swaps and security-based swaps. He's obviously already focused on that during his tenure, and he's already focused on proposing additional regulation regarding the reporting of large positions. So I think that certainly could have an effect on some of the clients in the area. He has stated as part of his agenda that he'll be focusing on other things that could affect indirectly part of the derivatives aspect of what many of us do. So for example, reporting of transactions that are cash settled only. So derivative positions that are cash settled that currently don't get reported necessarily in Form 13Ds or Gs. So that certainly could affect monetization trades, activist trades, things like that, that are not strictly structured products related, but derivatives related generally. Gensler has stated quite a number of times that he's looking for his division of enforcement to be more active generally as it relates to mis-selling of complex products, as it relates to the marketing and sales of anything ESG related or anything that purports to be ESG related where there is substance lacking in the labeling. And that, obviously will segue into our next discussion on all things ESG. And there are supposed, rules relating to how funds can use that ESG label. I think many of us will look to those rules by analogy in terms of how we think about indices that bear the ESG moniker. So that'll condition how we think about things that are green or green structured products or ESG indices. And generally, the enforcement climate, I think we can expect to be very different from what we've seen in the last few years, where by and large, structured products have gone, have had a relatively kind of gentle couple of years from FINRA enforcement and from SEC enforcement. So not, without being an alarmist, certainly some things to be on the lookout for.
Thank you. I had the best of intentions. Thank you so much for that overview, Ed. It's really kind of sets the tone for how we anticipate the industry will be viewed by the regulators. So panel two, we're going to drill down a little bit on the underlines, the tried and true versus the new and novel. So that I'd like to introduce some of our new panelists. The first topic, it's getting a little bit dark in here. We'd like to get into, let's see, are our panelists on? Apologies for that. Yes, so Stan, are you with us?
Yes, I'm here. Can you hear me properly?
There you are, Stan. Good to see you again. How are you?
Yeah, I'm very good. Thank you. How are you, Keith? Thank you for having me on the panel. Appreciate it.
Yeah, appreciate
thank you, Mayor Brown.
Yep, and appreciate you jumping aboard. So Stan, you guys have had a terrific year in ESG. So just wanted to see if you could give us an overview of what you guys are doing over at Credit Agricole and what you're seeing in the market with your colleagues and competitors. And maybe, first of all, just introduce yourself to the audience and tell them a little bit about what you do for the firm.
Sure. Sounds good. Thank you, Keith. I'm Stan Varin. I'm in charge of structuring for capital markets at Credit Agricole CIB in New York. I've been with the bank for probably more than 12 years, and lately I've also been carrying the hat of one of the sustainable banking coordinators at Credit Agricole CIB as part of my structuring role. So tend to be quite involved in that space, and that's an area where the bank has been historically leading the charge and continues to lead the charge across products. Obviously, we're glad to see that the market is catching up to this trend, and we're seeing significant growth in the sustainable ESG space across products. I believe last year 2021 was a record year for green bond and sustainable bond issuances. There was a very significant growth of sustainability-linked bond instruments. That was really the news. That was a new product that was introduced late 2019, and despite or thanks to COVID, I think there's been a even greater emphasis and interest for sustainability-linked products that really drove the growth, the year-on-year growth significantly to reach new record levels. So the market, continues to develop across products. Clearly, on the fixed income side, we've been quite active on the fixed income structured product side across, obviously green bonds with green use of proceeds. We've placed, a large number of, structured notes in the US market. We see a growing interest from the institutional investors. I believe there's, probably a scarcity of issuers in the, green bond space, especially the ones that are able to provide structured or lightly structured payoff to investors that are a bit more tailored to their needs. So, we saw a very good growth in that space, but also we saw growing interest for, socially responsible investments. So a number of structured notes actually were not green, just for, not green for the environment. They were targeting social improvements. So the S of the ESG, not the environmental part of it. And that has been also a growing part of the market. And we see a greater demand. There were some notes, in 2020 targeting, COVID relief. But in 2021, it continued with some, social investment, social housing, a number of, socially directed investments on the back of the funding raised. So that's also an interesting new development in the market. On the equity side, clearly the thematic indices continue to grow. We have a number of, thematic indices on, environmental space, but also sustainability scoring space across, markets, whether it's US, Europe, and we also have some joint US, Europe kind of best of thematic indices, which have been growing in interest. Typically, what we see in that space is that the thematic is often obviously paired with a mechanism that geared the index toward, attractive structured notes payoff, like autocalls. So we see the fixed dividends mechanism being quite popular. Or in Europe, we call it also the decrement on the index or synthetic dividend. So that's clearly a growing space. And there, we did one of the first issuances, for instance, in the Nordics, listed on the Nasdaq, of such note with the thematic indices on the actually healthcare companies, and where the proceeds actually were invested. It was a social bond where the proceeds were targeting social projects. So that's, I would say the big picture. And, when I'm mentioning across products, so we're talking about structured notes directly, but on the OTC market as well, we're seeing a growth of the market. We probably did the first, sustainability-linked derivative in the Americas this year. So, it started in Europe, and we've been, working on with a number of, our, institutional corporate clients to arrange, sustainability-linked derivatives, where basically there's an incentive on the derivative, aligned with the, environmental strategy of a company. So in the same manner that they would do it on loans, now clients can also do it on derivatives. So that's also something that has been catching up here in the Americas. And same thing on the repo market, where now we are seeing demand and transaction on, green repo, whether because the funding is allocated to green projects, or because the collateral is only green bonds, or because the client is willing to put a sustainability link mechanism to its interest payment. So that's also another area where sustainability is progressing in capital markets.
Where is the distribution coming from primarily for the ESG space? Are you seeing dedicated funds? Are investment banks investing their asset management arms? Go ahead.
Yeah, no, it's a very good question, Keith. So in the US, clearly we see a significant demand from the middle market space, through regional distributors. Number of institutional clients of large size, medium size have portfolios, sustainable portfolio allocations where they are looking for ESG assets to invest in. So clearly we see demand from that space. There's also some demand from the private clients, private wealth management networks, from their private clients. I would like to say that I believe there's a lot of talk on that front from the private banks, but I feel like it has not necessarily caught up as fast as we would have liked to in that space. But I still see it's been we've been placing more nodes that we used to place before. One interesting trend is when we're talking about distribution is that there is the thematic indices, which enables you to filter the companies based on ESG scoring, but there's also the use of proceeds. So as I said, we can do this double green feature where the cash and the funding is also invested targeting green projects, and the index, the second layer of the index performance is also green thematic. And that I feel as probably is getting more traction and good traction with the private banks and private clients. So I expect this space to grow with the private banks. And elsewhere in the world, clearly, private banking is a large contributor to green nodes, but so is also institutional clients. There's continued demand for green assets. So that's the big picture.
Absolutely. It seems like there's no place to go but up in terms of the demand that we're seeing for ESG, green, sustainability themed investments. So terrific. Thank you for that, Stan. Yep. I'd like to flip now over to cryptocurrencies. And Dimitri talked a little bit about this, but I want to go to Anna first. Anna, can you talk a little bit about what you're seeing in terms of what's bubbling up with cryptocurrencies? We're not seeing all that much. There was one FX deal that was done last year, according to Prospect News, but we hear a lot about digital cryptocurrencies and not seeing much yet. But what's going on from your perspective?
Keith, I think that's fair, that we're not seeing much yet, but there certainly is a lot of interest. So as I'm sure folks in our audience know, there are various listed futures contracts that have been approved, and so it would be possible in theory to issue a product that's that references one of the traded contracts. However, I think that in light of all of the uncertainty regarding the SEC's position, the CFTC's position regarding crypto-related assets, it would be difficult for an issuer to use its SEC registered platform to issue an SEC registered product that referenced a crypto-related asset. I think it might be easier to do something on an exempt basis, whether that be 3A2, 4A2, or 144A, certainly. of course, 144A would probably be the easiest because it was going to a very sophisticated investor. I think the other issue is if you weren't referencing a listed instrument, then and you were referencing another crypto asset, you would be concerned about the status of that asset, right? What is it? You would have to presume, given the lack of legal certainty, that that asset was a security in light of the ambiguity. But there would also be the concern regarding hedging of the exposure, how one hedged the exposure after the issuance. And I think that many firms still have not fully resolved the extent to which they want to be involved in transacting in these types of products or engaging in hedging in relation to these types of products. FINRA has been very careful to remind broker-dealers, FINRA member firms, that to the extent that they're doing any business that relates to crypto or crypto-related assets, that they need to advise FINRA of that. They need to sort of not really self-report, but for lack of a better term, they need to identify themselves as a firm that's engaging in business in digital assets, as they call it, which essentially is, a flag for FINRA to come calling and to ask questions about the type of business that the firm is conducting, the kinds of policies and procedures it has in place for the type of business it's conducting, and the kinds of policies it's implementing with respect to custody, any crypto-related assets, if any. So it just opens a set of issues that many firms are at this point unprepared to deal with. Going back to my prior point on the last panel, one of the areas that the SEC has been probably most aggressive in pursuing from an enforcement perspective has been in going after DeFi and going after purported crypto-related exchanges. So I think that many are just sort of keeping a distance. At least, that's what we see. But I'll hand it off to Dimitri to share his perspective.
Sure. Thanks, Anna. What I was referring to before, and we're all on all kinds of sites and get information and see things. So it's not necessarily confidential. It's actually out in the public. But there is a company that kind of sees itself as an investment bank of sorts, building a platform in crypto. They just launched a vol-controlled crypto index product. And I thought that was fascinating to see how, we're all involved in some vol control QIS type products, that it's morphed into the crypto space. I don't think it's available in the US, but just the way the transformation of what we do in structured products can transform into other asset classes. I think people need to really think hard about how crypto fits into all kinds of things that we do on the structured product side, because it's coming. And the other place where that's going to be relevant to, but it will be also cannabis related indices. These are themes that, at least, when you watch the markets, people say you should have 1% of your invested assets in crypto. So I just found that fascinating, and it recently happened.
Appreciate that insight. We got a question that goes back to ESG. I don't know if Stan has any experience in this. The tax question is that some U.S. tax lawyers believe that ESG indices are based on discretionary criteria. Therefore, structured notes that reference such indices are reportable transactions for U.S. tax purposes. So Stan or anybody else on the panel, is there any insight that you might have on that question?
Don't believe tax is my forte. Maybe I would leave this to my Brown, the experts, if any, on the panel.
Fair enough. And any insight on the tax aspect
of crypto?
No, I'm sorry, ESG. The question was related to went back. The question was about ESG is a reportable transaction based on the construction of certain indices that are related to ESG. I think that's a tax question. And I'm not sure.
So okay. And as to crypto, there are a whole host of interesting tax issues, and that itself could make for a great panel. My tax colleagues have written quite a bit on some of the interesting tax policy questions on crypto-related assets. Some wonderful pieces are on our website on that. On ESG and ESG indices, I think you come back to the same tax questions that we always come back to on any index, and that's the basket notice question, and whether an index has elements of discretion or not. Obviously, with Credit Agricole, with Stan, and with his colleagues, we always review any index for elements of discretion, and try to ensure and do ultimately ensure that any index is a rules-based index, so that there aren't any elements that are discretionary, so that everything is rules-based, can be reduced to writing, can be reduced to a formula, and is not discretionary, so that we don't have any tax issues or any reportable transactions, or any basket notice questions. And that goes for whether it's an ESG index, an index that has, to Dimitri's earlier point, which we'll cover in a little bit, whether it's an index that has like AI elements or other machine learning elements. The basket notice and the discretion elements are kind of things we always look for.
Makes good sense.
Yeah. Keith, I wanted to just reiterate the one thing Anna said. I heard this a number of times, that people talk about ESG and the basket notice, and if this is a reportable transaction. And I just wanted to reiterate, that's a discretionary issue. ESG, it's not an ESG issue. It's the same issue we've been dealing with, for tax and for other purposes for many, many years. ESG itself, in and of itself, doesn't cause the issue. It's just, as Anna said, it's having an element of discretion where you might have to look at it and ensure that people are comfortable that you don't have that. So I just wanted to make that clear again, that it's not ESG. It's the same issue we've been dealing with for many, many years.
Appreciate that. That's great. Thank you, Joe. So that brings us to our next topic, which is last year we saw quite a bit of an uptick in the number of vol control strategies that happened. So our next subtopic is concerns vol control, as well as kind of the state of play with prop indices. And so, Dimitri, you had spoken a little bit before, about prop indices that have been used for some of the insurance products. You want to give us a sense of what the state of play is on the prop indices, and then I'd like to go back over to Anna and see what she's seeing in the business as well.
Yeah, like I mentioned, I think in that prop space, customization of what we do and others do in the space, and we know of the large competitors in this space. There is a trend to a little more simplification. There's also, whatever's moving the market, ESG, for example, there are a bunch of indices that were coming around in there. And also new asset classes as they get more adoption, and there's more clarity from, as Anna mentioned, the SEC and others as to what you can do in crypto or cannabis, which involves obviously cannabis the federal government from a regulatory perspective. I think those asset classes are going to come into the prop world, the prop index world, the FIA world in 2022. But I think it's going to take a little bit more time before we see some real traction in that space. Anna?
No, I agree with you, Dimitri. I think that's absolutely right. We are actually seeing a move to somewhat simpler products and simpler indices. I absolutely right on that. Keith, nothing else to add. I think all of those comments were exactly on point.
Got it. Hey, Stan, did you have anything to contribute on the vol control or the or prop industry side? Yep, go ahead.
Yeah, I mean, so on the vol control side, that's where, I mean, from where I sit, I would say that what I've noticed is that vol control was quite popular when we had a lot more market link CDs, principal protected products, because it was a great option cheaper, right, to have a volatility target, volatility control mechanism. Was a great incentive to make those option price reasonable and cheaper, and that made the product more attractive, or have the greater participation on those market linked products. I believe you show the statistic of the growing notes market. We are at record levels. It's probably also a bit at the detriment of deposits and market link deposit products. So in that sense, and in that space of the notes, the autocall is really the big winner, I would say, by far, versus a lot of the other payoff. And what I've seen there is that the shift is more into the synthetic dividends or decrements for those autocalls, which helps price the autocall better, thanks to this mechanism, right? So I think there is a bit of a shift from vol control to synthetic dividends, that is happening, and this is driven by the type of products and payoff that are popular with clients. So there's been a greater willingness to take principal risk under the autocall that maybe several years ago was not as important. Obviously, interest rate environment has been a big driver, because we're in such a low rate environment, at least until this point. This juncture, maybe it's going to change this year and the following years, depending on the Fed action. But clearly that has been one big factor. Also, what I would note on the dividend side is that, as you may all remember, in 2020 we have the big dividend cancellation phenomenon, and that has been hurt a number of banks in the market. So I think there's been also a bit of constraint, accumulation, concept, and the synthetic dividends enables to have a better management of dividend risk on the products, which as a consequence has been helping banks offer more indices, more products, thanks to this mechanism, rather than having accumulating too much dividend risk. So I see that synthetic dividends or decrements in the indices is gaining in popularity because of that, especially as we go longer in tenor of products or protocols at the time. So
Perfect.
yeah,
Stan. Appreciate your insight on it. We'd like to move to the technology side of the discussion with our participants from Luma and Halo. So that would be, we have Todd. Is Todd on?
I am on, Keith. Thank you.
Great. And Jennifer is on as well.
I'm here, Keith.
Great. Good to have you both. So this is quite a year. As we flip over to the technology side, let's talk a little bit about your respective platforms and your contribution to the record growth in the market this year. So let's start with Todd. Tell us a little bit about what you're doing over at Luma, Todd, and what's at the top of mind for Luma these days.
Sure. Thanks, Keith. So Todd Dilatush here. I'm on the sales side at Luma. We are a structured product and annuity platform that was really hatched in 2018. Fast forward to today, we focus on wires, bank broker-dealers, independent broker-dealers, and RIAs. We were initially a domestic platform, and we've since expanded into Latin America, and actually have an office in Zurich with, I think now potentially 10 different individuals focused on the India markets, and we have plans to expand beyond there. So on the structured note side, we focus on, support SEC registered, 382, Reg S. In Latin America, we've expanded into credit-linked notes. In Europe, we've also kind of brought on support for actively managed certificates. And for a certain select few, we actually support OTC auctions for issuers that actually outsource hedging to third-party providers. In 2020, we decided to take our breadth and scale on the structured product side and expand into annuities. So we hired a few people who are resident experts in the product set. I would say that we were definitely a little bit late to the game for the annuity support, but it gave us an opportunity to approach it in a slightly different manner. So 2020 was all about the build. 2021, a lot of the initial sales, heavy lifting. I always like to say, planting a lot of seeds in the garden, some of which have grown into mandates, and we have a healthy pipeline as well. In terms of forward focus for us is just continue to execute. Initially when I started, it was really a push type of exercise, and now we start to see different groups coming to us and presenting unique opportunities to us, and we really need to be focused on what we choose to focus our resources on in terms of expanding the platform. Generally speaking, the technology is supposed to bring efficiency and scale to various markets for primarily structured products, and we can't be everything to everyone. So being disciplined, staying in line with our broader strategy, and focusing on solutions that can benefit more than just one client per se.
Fantastic. Thank you, Todd. Joanna, I want to bring you in on the Halo side. Can you give us a sense of what you guys have been up to at Halo? First of all, tell us a little bit about your role, what you do for Halo, and what's top of mind for you guys as well.
Thank you, Keith. And thank you, Structured Products Association and Mayor Brown, for having us. Greetings to everybody. Nice to all see you virtually. It's been certainly an incredible run. I mean, looking at the numbers that you put up, Keith, at the beginning of this conversation, right? From that first, just the SEC product registered in the United States, that was, if my calculations are right, 36% growth from 2019 to 2020, and 31% growth from 2020 to 2021. That's right. If you want to look at the Halo story of that, put another 0 behind each one of those. So we have been really incredibly explosive in our growth in the market. We actually started in this space, broadly speaking. Halo is interested in democratizing protective investing solutions. So we believe that the world of defined outcomes is what is going to drive investor demand, and that specifically the ability to create kind of unique and bespoke offerings inside those wrappers is why essentially we're focused on the structured product space, looking kind of across wrappers from buffered ETFs to structured products to annuities. There certainly are reasons that an investor will go to each one of those. Our product supports all three. We've been live and in market with all three for a good while now. But started in structured products specifically because we believe in the efficiency of that wrapper. Interestingly, when you put kind of focus and attention in the distribution side, which we've done through technology, through a human wholesaling force and outsourced broker-dealer, we realized that we would get to a point thinking that this market would shift to more and more customization. You get to a point where you drive so much demand, and in like 300% growth year over year, that happens, that we needed to provide also technology on the sell side ecosystem to make the legal requirements, auto booking of transactions and everything more efficient as well. So we've built an engine and partnered with a Wall Street issuer in the space today that has had even more growth than the 300% on our distribution side that we've seen. So I would say holistically, we really believe in the efficacy of these products. There's a reason, certainly, for the growth that we've seen, and I think the market's trending in the right direction, but there are ways that we have found that we can kind of supercharge that growth. So like I mentioned, we started in the RIA market in 2017 with two investment banks, BNP, so thank you very much, and Societe Generale, which is actually my home bank, and with 3 different RIAs. Today, we serve about 6,000 different RIA firms and have moved up market pretty significantly, won mandates in this last quarter from a custodian and several bank broker dealers. So making some pretty good progress there in terms of growing that distribution landscape. And then really, we also moved into Switzerland in 2020 with a strategic acquisition, closed a Series C round of 100 million in September, which means with a bunch of money, there's a lot more growth to be made. So kind of the fire is lit under us to go global and go big in some pretty significant ways. I am our head of enterprise sales, so I look after our strategic relationships with product manufacturers. It's under my team. We also have a strategy connecting and sort of working within the web of wealth tech platforms. These products, annuities, structured notes, and ETFs will always be separate and on the side until it can be an integral part of planning, risk management, and reporting. And so there's a real focus for us there. And then distribution within those larger network firms is really my focus.
Terrific. Thank you for that, Joanna. On that, while we're on the topic, so with the explosive growth that you've experienced, as well as the explosive growth that we've experienced, generally speaking, in the industry, what role do you attribute to the new platforms in driving that? Have you guys felt that you're change agents in mainstreaming structured notes, or it was inevitable in a bull market like this, and you guys are just well positioned? Where do you fall on that?
I mean, I think it's certainly change agent through technology. First and foremost, there was no regulatory sort of standard framework of this is how a firm can show that the advisor understands these products. So I think basic education was a building block that needed to be made in order for advisors to get access, and for larger wealth management firms who have compliance restraints to be able to understand and make sure they kind of check that box. But I would say product access and the way the massive shift from calendars to customs that we've seen over this last 2 years certainly has raised adoption, at least what we've seen in the RIA space for sure. And I'm seeing it trickle finally up market to other larger wealth management firms. The reality is advisors are looking for ways to differentiate their practice, and structured notes are a beautiful fit for that. The other reality is just where we're at in the economic cycle. I mean, when you think about the explosion of RILA products in the annuity space, I think that's a direct attribution to where we're at in the market cycle. Advisors looking for a comfort story for their investors, and for, again, the efficiency of those two different wrappers and how they fit in client portfolios.
Sounds great. Thank you for that, Joanna. Todd, I want to talk a little bit about custom versus calendar. Are you guys doing quite a bit on the customization side, and are you seeing that as an uptick from where it was this time last year?
Yeah, I would say so. To echo Joanna's comments, the reverse inquiry or custom space has definitely exploded. I think ourselves, Halo, Simon, technology in general has really empowered individuals to be more prudent with their purchasing process, price discovery, things of that nature. We have a module that actually allows either program managers of a broker dealer or some of the more sophisticated RIAs that want to take ownership of price discovery to model up an indicative structure on screen, and if they choose to do so, move forward and actually get trading levels with the issuer. So is absolutely streamline that process, and that process wasn't around a few years ago. In terms of the growth, things like that, if I think of some of our larger clients, the wires, we've really automated the origination function of those businesses, where they're using Luma to completely price their open architecture calendars and the reverse inquiries to the platform. And the volume numbers are significant, but you really have to look at the number of notes that are being brought to market has gone up significantly. So I do think the technology has brought scale to those larger clients that are built for speed, that were doing a good amount of business. They're probably doing a lot more. On the slides you shared when the panel started, it'd be interesting to see what the unique number of notes were over the last 3 years next to the volume numbers as well. And I suspect they've grown significantly.
Interesting. Joanna, back to you on that, on the same topic. You actually raised it, custom versus calendar. How has that shifted over the last couple of years from Halo's experience?
It's funny, Keith, we were at conferences in the structured product space 3 years ago saying customs are the future. And everybody said, no way, are you guys crazy? So we built that infrastructure 3 years back. And at this point, it's a pretty well fine-tuned machine. In fact, we're getting firms that are trading more and more structured products on their desks saying, I'm dying. I can't handle this call around market. I mean, that's what I did in 2001 on a derivatives trading desk. Until kind of technology and democratization came in to make that available at the click of a button. We saw that trend 3 years ago and are definitely on the forefront of seeing more and more client demand for that. I also think it's been really interesting to see the banks themselves evolve and the technology in the banks for where they need to put their resources in terms of efficient and quick pricing as well, and speed of docs and all of that. Like I talked about in my introduction, that efficiency on the issuer side is absolutely going to be paramount for this market to continue to grow and to continue to bring people into this space that have never transacted before. I mean, I think, yes, we've done a fantastic job and there's explosive volume. We still have, 7% of financial advisors in the United States that buy this product. There's so much more to go. And again, it's buy-side technology and sell-side technology working together in order to make this growth sustainable in a way that works for our bank partners and for ourselves.
Sounds good. Todd, so aside from structured notes, tell us a little bit about what else you guys are selling. I know you're selling annuities. Are there strategic alliances? Are you going out and doing tie-ins with other firms that do alternative assets? What does it look like in the near term for you guys? And congratulations on your own recent round of financing. I believe you guys closed 80 million recently. So congratulations on that.
Appreciate that. On the annuity side, I can talk about that for a moment. Again, I mentioned earlier, we're a little bit of a late entrant. So we took a different approach. So we partnered with Canex. And then we also partner with Morningstar. So our platform, we support all annuity product types: SPIAs, DIAs, FIAs, RILS, fixed rate, and even variable annuities. So a broker dealer can create their shelf right on screen. So we thought it was important to make sure that all annuity products were available in one space. We've tied that into a post-sales lifecycle manager. We've integrated with Firelight, iPipeline, and I suspect probably EBIX in the near future. So, there's certain things that make sense building on your own, and there's others where it makes sense to leverage other experts in their market. So we're always interested in broader partnerships. We have one in the pipeline. There'll probably be a press release in a few weeks where we thought it made sense to go forward more on the analytics side. But generally speaking, I'm sure that the other platforms we've seen the press releases. It does make sense to collaborate with other fintech solutions where, as a whole, it brings a better solution to that client base.
Makes sense. I think what we're going to do is turn it over to you guys to give us a 30-second, 60-second overview of where you think the markets are heading, just generally speaking, from where you sit. How do you think the markets are going to shape up for 2022? And we'll start with Stan. Stan, what do you think?
Sure. Yeah.
Surprise.
It's the crystal ball. It's the crystal ball time, right?
Crystal ball time it is. Yes.
Your
Go right
favorite. Oh, well, I don't know. I'm probably going to be on vacation next week.
Nice.
Something like that.
That's
No,
something.
no, no. So more seriously, I think we're changing a bit the regime in 2022, right? I mean, clearly we had, very strong 2021 for equity markets. I think the Fed is coming into the game. Not that they were never ready for. If anything, they were supporting the equity markets to some extent. And so I feel like there might be some changes, this year, maybe a few more, defensive plays, bit more, bearish and, maybe more fixed income, oriented, strategies. I believe also inflation is clearly a theme that, is not really visionary. It's already there. When the Fed says it's a transitory situation, I believe the past few times when they say it's transitory, it still lasts a couple of years, if not more, right? So I believe inflation is an interesting theme, especially when you look at it in light of equity markets. We've looked at a concept of real equity performance, basically net of inflation. That could be something that makes sense for investors to basically have a protection, against inflation in their investment strategies, in a way. So, I believe that could be something, to look for. And in general, fixed income, floating rate indexation, or to try to benefit from rising rates. So that's what I would say.
Great, thank you, Stan. Todd, how about what do you see in your crystal ball? You're on mute.
Yeah, it's interesting. I think on the product side, obviously with these sell-offs, it does hurt the auto call rolls. We do a good amount of volume through the platform each month, so I've got a very, kind of a unique view on flows in general. If we look at our Q4 run rate compared to what we closed in January, January was flat. And, we also tracked the auto calls that are coming in. So, if you just looked at that statistic, I personally expected a slightly down month. I don't know if Joanna mentioned it or someone else on the panel. I do believe just a flat January is a result of new buyers coming into the market. So I don't know if the equity-linked note market will be impacted that much. If we see rates rise, put on my old hat, step-ups, fixed to floats, absolutely. Rates, lightly structured rate products take off for sure. I think 22 is also the year of some type of crypto product. It has to happen. We get questions about it. I'm sure other platforms do as well. There's people out there sniffing around trying to figure out how to use it as a reference asset, et cetera. So I think that this could be the year for that. On the platform side, I'll just close with, in 2018, when I joined Luma, the market, the structured product market, very small percentage of product or flow going through or touching platforms in 18. Fast forward to that 21 number of the 90 plus billion, I have to assume that at least 70+% of that total number went through a platform in some way, shape, or form. Mm-hmm. My question is, a year from now, what will the percentage of annuity flows be going through these platforms? It's still very low on a $250 billion market. But again, my crystal ball, I think you're going to see a broader adoption to these platforms on the annuity side. I'm not an annuity expert, but just, being on these prospecting calls and stuff like that, there is an apparent need for some efficiencies on the technology side with that product set in general.
Terrific. Joanna, you get the last word here and predicting 2022. What do you see?
I'll be honest, Keith, I'm not going to predict the market, but I'll tell you that you could price it up and structure it on our platform for sure. I do think it is, Todd, I totally agree. I think this is the year that crypto is going to happen. There's enough demand. We see it all the time. I also think that there just will be continued efficiency, like I talked about, of kind of webbing into the ecosystem. The fact of having any of these kind of defined outcome products sitting separate and apart, I think will finally embed themselves into the way that people are making asset allocation decisions in a more efficient way. A lot of the kind of engine and tools that we built around that will help do that. And I'm sure kind of the same with Luma. And I also just think there is still more sales outside of the autocallables for sure to be done. We had our best, we had a better month in January than any single other month in 2021. And we're up 150% year over year from Jan to Jan. And we don't sell autocallables hardly at all. So there is certainly business to be done in a very new and different way. And I think that will just continue to happen. So I'm not as necessarily worried about kind of autocall drop off or flat markets. We know that advisors are getting more and more sophisticated in the way that they structure these products and the way that they use them effectively in portfolios. So pretty positive for where we go from here.
Fantastic. So we'll wrap up the panel from there. Want to thank Todd, Joanna, and Stan for participating on our second panel. Thank you so much for joining us.
Thanks so much, Keith. And yes, I just want to echo Keith's thanks to all of our panelists on the two panels. We really thank you for your time. We know how valuable it is and how busy everyone is. So appreciate very much your making time on a weekday evening to join us and for sharing your insights with us. On the slide, you'll see some additional resources, some of our newsletters, our glossary. We hope you'll visit and subscribe to some of our materials. Our derivatives blog, our IBOR transition blog covers some of the issues that both Joe and Dimitri talked about and that we talked about during our first panel, and our securities law blog. Look forward to being in touch with all of you in the coming weeks. And thank you, Keith, again for partnering with us. So good evening to all of you. Hope that in the spring, Keith, we'll be able to do our conference in person and to seeing everyone in person once again. So have a good evening.
Here's to it. Great to see everyone.
You too.
Thank you so much for participating.
Thank you for having us.